In this video, I'm going to suggest a couple of instruments for you to actually start trading. Now, we're currently on the Dow Jones, which is what we've been looking at in the last couple of videos, so I thought I might as well start with this one. Now, the Dow is a bit of a beast, okay? It tends to sort of go sideways in a really tight range, unless it's like the Asian range or whatever. Little bit of chop, and then boom, you just get these, you can see them everywhere. You'll get these breakouts, you'll get these just really big directional moves. And the reversals tend to be equally spectacular. Look at this big bearish candle, pin bar, reversal. Okay, it reverses 100% of the move. Massive spike up, 100% reversal. Again, look, even this slower move reverses all the way. Big bearish candle, big bullish reversal, big bearish reversal. It just goes on and on and on. This is literally what happens. Everywhere you see a big push, you get a big reversal. Look at what's happening right now. It's just dropped in one candle. This is a 1 hour chart. It's just dropped an entire 250 points. Look at it reversing already. Look at the size. If you go from, let's just measure this actually. If we go from the tip of this wick to where we are, that's 175 point reversal, which is roughly 50% of the move already. Okay, so the Dow Jones can move very, very quickly. Now, it's not particularly beginner friendly. If you are just beginning, I actually recommend you do this on demo. Give it a go and see if you like it. Some people love the Dow Jones, some people absolutely hate it. So give it a go first. This is the first instrument I want to recommend to you. I'll just drop down to the 5 minutes and you can see how quickly this actually happens, okay? So if you imagine, or not if you imagine, if you put your grid in here, you can see how many trades you would have actually had in this period, okay? So it's very, very quick. Now, if the Dow Jones is too fast for you, you can move on to this one. This is the NASDAQ, okay? So the NASDAQ is, think of it as the Dow's kind of cousin, okay? They're very closely related. They actually have some of the same stocks in them. But essentially, the NAS is like the Dow Light, okay? It's not quite as bad. It still moves more than most Forex pairs, but it only moves about half the distance of the Dow. So on the Dow, we just saw that huge move that happened, and you can see it's just not that big at all on the NAS. It's pretty much still the same thing. We've got a severe drop, 100% retracement now. Look, it's pretty much back where it started. So it behaves very, very similar, but the actual distance that it moves will be about half, which means it's much more manageable for beginner traders. So have a go at the Dow, and if you can't handle the Dow, or if it's just not your cup of tea, drop down to the NAS and see if you prefer that. A lot of people do prefer the NAS over the Dow. Now then, let's move on to Forex. So the first Forex pair I'm going to recommend is Pound US Dollar. Now, I really like Pound US Dollar. It just sort of fits, okay? Let me go on a 1 hour chart. Oops, that was a 4. So as you can see here, look how nicely it just bounces between the 100 pip levels. You will see this all of the time with the pound. Now, I'm not saying that it can't kick off a fairly big trend, because it can. But as we've just seen in a previous video, you pick a point or you pick a loss limit, you get out, you take a loss, and then as soon as it starts to do this again, you just keep winning and you make it all back. That is the whole point of this strategy. So the Pound US Dollar moves probably about half of the NASDAQ or less, and probably about 4 to 5 times less on average than the Dow. So again, this is much more manageable. Now, obviously this is day trading, so if you do get the direction wrong, let's just take this move as an example. If I draw this on, let's imagine, I'm not drawing that very well. Let's imagine that we did stick on a buy trade up here for some reason, which you wouldn't do because it's very clearly a resistance level on the round number, so you would have been selling. But for whatever reason, let's say we stuck on a buy, price drops away, and obviously let's assume that this is our bedtime. You need to go to work or you need to go to bed and you can't watch the charts. Well, you would have to take this loss, or you would have to be happy to leave it running while you weren't watching it, okay? But the idea of day trading is that you're not really having trades running overnight, or when you're not there, you're in and out, okay? So this is more manageable because this distance will be less, there will be less trades on, the losses will be smaller. Everything in Forex is slower and more gradual and more gentle, okay? The indexes, like the Dow and the NAS, they are quite, difficult to trade in comparison to Forex. So the Pound US Dollar then is a really, really good sort of beginner's Forex pair. Now, if you want something even slower than Pound US Dollar, which you may or may not do, have a look at Euro US Dollar or Euro Pound. So both of these, what is going on? As soon as I have this indicator on, it won't let me resize the chart like that for some reason. Yeah, let's bin that off for a sec. The euro pound moves even less, about 30, 35 pips a day, something like that. So about a third of the pound US dollar. Now, you can see there's still lots and lots of little V-shaped reversals, which means that when you're buying and selling, even if you get the direction wrong, a lot of the time you're going to be able to get out. But these trades are not particularly quick because it's such a slow-moving instrument. Now, with this one, you may actually end up holding overnight, but you'll feel confident doing it, even though this is a day trading strategy. With stuff like euro pound, I mean, just look how sideways it is. You can literally leave this running and check it in 3 days' time, and it will be, and I'm not joking here, it'll be like 10 pips from where you left it. In fact, you can pretty much see that. Look at the dates at the bottom, 23rd, 24th, 27th, 28th. And look, if you'd bought or sold anywhere in here, days later, it hasn't moved. It's still there. This is literally how this pair trades, okay? It goes nowhere. So again, this is another very, very slow beginner-friendly one. Now, some stuff that's probably actually worth looking at is Aussie New Zealand and Aussie CAD. Now, the difficulty with these pairs, okay, pairs are very different, okay? Each one has different spreads, different behaviors, but Aussie CAD and New Zealand, Aussie New Zealand and Aussie CAD are two of the most naturally mean reverting pairs. Now, what does that mean? It means that they go back to their average price very often. And if you just sort of look at the price action, what we're looking for is how many reversals it has. Keep looking for V shapes, okay? And you can see V shapes absolutely everywhere. This is what lets you out, remember. We are using an averaging strategy, a grid strategy, where we add more trades when we're wrong and we need a reversal to get out at a profit or break even. So when you see something like this, which is absolutely full of these V-shaped reversals, you can see straight away that's a very good instrument to trade. Now, the bad points, as I said, are the spread, particularly around the New York close. Now, as a day trading strategy, you should not be holding overnight most of the time you want to get out, which means you should not be encountering the crazy 20 to 40 pip spreads that you sometimes get on these pairs, okay? So sometimes you'll have to cut trades. You'll make it back when you go into a choppy sideways period. Try and avoid the spread. Other than that, experiment a little. Pick sort of whatever it is that you currently trade. You tend to find that people trade their own currency. So if you're from the UK, you'll be trading pound pairs. If you're from the US, you'll be trading US pairs. I see that a lot. Also pick one of your favorites and sort of see if it's any good. But ultimately what you need to do is just experiment with some instruments at the start, find out what works and what doesn't, and also for your risk level. But definitely have a go at the indices as well, just to see if you like it. In the next video, what I'm going to do is I'm going to give you a little bit more information on the Dow, the NAS, the S&P, and also something called the VIX, okay? And I'm going to show you the relationship between them and why you'll find it useful. In this video, I'm just going to talk about the relationship between the US indexes, okay? So in this top window, we have the Dow Jones Industrial Average, and in this bottom window, we have the NASDAQ, okay? Now, these are both US indices. They actually contain some of the same stocks. And as you can probably immediately see if you compare these charts, they're incredibly similar, okay? They're very highly correlated. They have what's called a positive correlation. In other words, they move in the same direction at pretty much the same time most of the time. Now, there are some differences on the chart, so you probably already spot that because correlation is never perfect. But they can actually be indicators for each other. Now, I tend to find that the NASDAQ slightly leads the Dow Jones. So what you'll tend to find is that if the NASDAQ starts going up, the Dow Jones will follow it. And it may be a couple of minutes, it may be a couple of hours. What you want to pay attention to is when one of them is going down and one of them is going up. Because they're highly correlated, they will snap back, okay? They will go back into alignment. You can't really have an extended period of correlated instruments moving in opposite directions. So if one of them's going up and one of them's going down, you need to sort of work out which one is going to correct, and that's obviously an opportunity. Let's also have a look at the S&P 500. If we put that on, that chart barely even changed. I'll just flick quickly between the NAS and the S&P, and I want you to just watch this chart. Okay, you can see, look, there's almost no difference between them. So again, the S&P 500 very highly correlated to the US 30 and also to the US 100. So this is another example where you can sort of have a look, see which direction it's moving in, and it'll possibly give you a clue as to the direction of the other. And one more thing I want to point out is the VIX. Okay, now if you don't know what the VIX is The VIX is a volatility index, and you can see it says volatility S&P 500. So what the VIX actually measures is investors pulling money out of the S&P 500. Now, as I've just explained, the S&P 500 is very highly correlated to the Dow, and therefore, when people pull money out of the S&P, it moves the VIX, which then gives us a clue as to the direction of the Dow. Now, what you will see here is a very clear pattern, okay? Whenever the VIX is moving lower, okay, look at this period here, the VIX is moving lower, the Dow Jones will be moving higher. If the VIX is staying low, as it is here, it's chopping sideways right at the bottom, the Dow Jones is usually continuing to rise, okay? If the VIX moves higher, the Dow moves lower. And you'll see this, look. So VIX moves higher, Dow moves lower. VIX moves lower, Dow moves higher. So this, because they're pulling money out of the S&P, which is correlated with the Dow, that's why these movements actually align very nicely. When I look at the S&P, when I look at the VIX, the volatility index, I typically only look at the daily. It's not the same kind of chart that you get on an index or on Forex. This is a totally different kind of chart. You can sort of see, if I just zoom right out, you don't see many charts looking like that. Remember, all it's doing is measuring the amount of money that is being pulled out by investors. So investors at any one time are either pulling money out or putting money in. They actually call this the fear index, okay? Because it's just an index of how scared people are. If people are scared, they pull their money out. If they are confident, they put their money in. And you can see that. I'm sure you've probably had the COVID spike catch your attention, which I think is probably the highest value it's ever had, or possibly the one in 2008. Can I go back any further? Where's 2008? There it is. Look at that. Absolutely massive. A value of 95, which, means nothing to me. It just means people pulled a lot of money out, and I'm pretty sure if you scroll back to that period on the Dow, you'll see a massive drop, okay? So this is another very handy little tool. It's not quite a leading indicator, but it's handy because you can sort of predict price movements in the same way that you do on a chart, okay? So what you can very easily see is, look at this level here. If I just hold this dashed line here, you can see that all these highs keep hitting it and then dropping. So this almost becomes resistance. Now that allows you to look at the chart and say, okay, if price is moving up towards this level, investors are probably going to start pulling their money out again from that point, okay? In which case, you can then predict the movement of the Dow if that's what you expect investors to do. So stuff sort of along those lines. It's a very, very handy tool. So yeah, that's the relationship between the US 30, the US 100, the S&P 500, and the VIX. Very, very useful for helping you to predict the direction of any one of those instruments.